Hello, everyone. My name is Alexander Gasenko. I'm a mortgage broker, and I'm also an economist. I studied economics at Ryerson. I'm going to share my screen. Just give me a quick second here. Okay, so as I said, I'm a mortgage broker, but I also studied economics at Ryerson. And my goal here today is to provide you with an economic update on today's market, as well as provide you with some valuable insights on how to get the best mortgage or the most competitive mortgage rates and terms. So let's begin with the economic update. So before we figure out where we're going, we have to see where we started. And as you can see from this graph, this is Canada's inflation rate. So initially in January 2021, at the bottom here on the left, we started at 1%. This was during the middle of COVID when everybody was staying home, nobody was going out spending any money, and basically everybody was saving. Then, as things started to open up, people started to spend more, people started to travel, people started to buy things, and inflation steadily rose. Now, at first, the Bank of Canada thought that this was normal because, well, it's normal in a healthy economy to have inflation. It's considered a good thing. But the fact that it went above Bank of Canada's target rate of 3 to 1%, it became a problem very quickly. And as inflation got to 8.1%, it became a very big problem because things that you are buying today were becoming more expensive. Things that shouldn't be more expensive, like cars, were becoming more expensive the next day. So consumers were running out the door to buy things, and this created a huge problem for the Bank of Canada because this creates an inflationary spiral. And nobody wants their currency to devalue, so the Bank of Canada, they increased the interest rates from less than 0.25% all the way to 5%, which is where we're sitting at today. Now, the most important thing to understand is that it takes a while for the interest rates to filter through the economy. If you have a mortgage and you're on a fixed rate, it doesn't matter if the Bank of Canada raises its interest rate to 10%, you're still going to be paying that low interest rate that you fixed until you come up for renewal. So even though the Bank of Canada increased its interest rates fairly rapidly, not everybody felt the effects that the higher interest rates brought with them. Sure, some people stopped going to the dealership and buying new cars because now you can no longer get a 0.99% interest rate. You're getting somewhere in the ballpark of 8 to 9%. But that's not the majority of people. The majority of people have mortgages, and these mortgages are slowly coming up for renewal. So in this graph, I want to show you the share of mortgages that are coming up for renewal. The most important thing to understand here is that the blue is fixed rate mortgages that are 5 years or more. Yellow is fixed rate mortgages that are 5 years or less, as you can see here in the legend. And green and red are variable mortgages. By the end of 2022, roughly just under 30% of mortgages, the majority of them are variable and fixed rates that are less than 5 years, were up for renewal. So those high interest rates that the Bank of Canada had imposed hadn't filtered through the system yet. But by May 2023, that number had increased. And by the end of this year, end of 2023, we're going to be sitting at roughly 50%. Now, by the end of next year, as you can see, this blue part is steadily growing. So the amount of consumers feeling the high interest rates will increase, therefore slowing down the economy. Now, the Bank of Canada, their goal is to bring inflation in line with what their target is. Their goal is not to crash the economy. So they have to walk a very fine line when it comes to raising interest rates, but not overdoing it too much, whereby they'll crash the economy. And the only thing that they can do when they crash the economy is they have to cut interest rates. So nobody wants this turbulence, And the goal is to make a smooth transition from high interest rates and high inflation to inflation under control, and then bring down interest rates. So that being said, let's look at the Canadian inflation. And as you can see from the left of the graph, inflation has significantly come down to 2.8% in June. It rose a little bit in August. This was because of gasoline prices. So inflation looks at prices that were 1 year ago and compares it to prices that are today. And today's prices for gasoline, well, what happened was last year there was $60 a barrel, and in August this year was $80 a barrel. So it was a little bit higher, and that's why inflation rose. But overall, inflation has been on a downward trajectory, and in October we are sitting at 3.1%, which is almost in line with the Bank of Canada's target. So we can say that the interest rates, the higher interest rates are working, inflation has come down, and now it's up to the Bank of Canada to make sure they don't overdo it, because the high interest rates that we have today, they are having a negative impact on the economy. And it's very important for the Bank of Canada to make sure that they moderate their policy according to the data that's available to them. So I want to show you this graph next, and this graph is very interesting. It's directly from the Bank of Canada website. The blue line in the center is the target rate. It is between 3% and 1%. So this is the target that the Bank of Canada has set for itself for where it wants inflation to be. And the quote below is from their website. It says that inflation should be at 2% midpoint between 1 to 3%. So it can fluctuate between this midpoint, but it shouldn't exceed it like it did here at the top when it was 8% after April. So what I'm trying to say here is that the Bank of Canada has almost succeeded in bringing down inflation to where they want it to be. You can see it's pretty much touching this blue line. And the forecast that we're seeing from all the economists is that inflation will continue to fall, because as you saw, more and more mortgages are coming up for renewal, and people whose mortgages come up for renewal, they don't want to lose their house, they don't want to foreclose, they'll cut back on some spendings. They might not buy a new car, they might not buy a new TV, they might not go on a vacation, and therefore the inflation will start to come down more as these mortgages come up for renewal. The key here is that they don't want to overdo it, because if they crash the economy, they'll have to drastically cut rates, which is not what they want to do. And you can already see this taking effect. The Canadian unemployment rate has started to rise. It was at a historic low of 5%, and historically it hovers at around 6%. The projection is that next month it'll be 5.8%. And that by the end of 2024, it'll be around 6.7%. So another percentage point higher. Of course, like I said before, they don't want to overdo it, but historically 5% was way too low, which was part of the problem with inflation. There was very low unemployment, job vacancies were low, and employers were forced to increase wages. And by increasing wages, they were driving inflation. So we're on the right path here, and the main point is not to overdo it. Now, here is an interesting graph which is already pointing to the Bank of Canada overdoing the interest rate increases. This graph shows the Canadian GDP growth. So GDP growth is how economists measure each country's economic performance. If your economy is growing, you're going to have a GDP growth. GDP stands for gross domestic product. It's how much goods and services your country produces. Every country strives to increase their economy so that there's more products, services for the people in their country. So if your country's GDP is growing, it's very good. If your country's GDP is falling, it's considered very bad. And if you have 2 consecutive quarters where your GDP has dropped, it's considered a recession. So there's different ways to measure GDP. You can just take the goods and services and say, here's the GDP. Then you can adjust it for inflation. So for example, if you built a car this year and it cost $100,000 and you count it towards the GDP, then if you build another car next year and your inflation is 8%, and now this car costs $108,000, you cannot say that your GDP grew by $8,000. That's just inflation. That's just money devaluing. So real GDP is adjusting GDP for inflation. And as you can see from the blue line, which shows the real GDP per quarter, by the way, this is a forecasted future GDP ending in starting in 2024, ending Q3 2023. But anyway, as you see the blue line, it has already started to come down. So already we're seeing negative economic growth, or in other words, recession. And the yellow line is GDP per capita, real GDP per capita. Because our population is growing so quickly, we can take that GDP and divide it by each person. And because our population has changed so drastically from 2021 to 2023, it's actually already been negative for at least 4 quarters. So technically speaking, we are already in a recession, and the Bank of Canada needs to start cutting interest rates soon, because more and more mortgages come up for renewal. There's less money for people to spend, and the economy is starting to really suffer. So to add to the point that I just mentioned below, here's the Canadian household savings rate. As you can see, in 2020, it peaked when everybody was staying home, nobody was going out, nobody was spending, and it has come down significantly since then to around 5.1% today. This graph is very interesting. It's from RBC cardholder data. I don't know what kind of privacy agreement RBC signed with the people who bank there, their clients, but they took their data and they're showing us total retail sales activity and how that retail sales activity has changed. The interesting part is that total resale sales activity is down, but retail sales activity, excluding cars, gas, and groceries, is up. And you might be wondering, well, why is that? People are spending less money, the economy is suffering. Why is retail sales activity up? And I have an answer for that. That is because we have a lot of people coming to the country. The new non-permanent residents have totaled in around 600,000. If you add the non-permanent residents, this is the blue graph, the blue line here, and the net immigration, this is the light blue line, and you have the first quarter and second quarter of 2023, you'll have around 600,000 people have come into the country. So all these people, they need to buy TVs, they need to buy furniture, they need to buy things to set up their life in Canada. And if you think about it, regular consumers who already live in Canada, the regular people in Canada, they might be cutting back. These people are coming in with money, they're spending, and they're actually supporting our economy. They're propping us up, because if it weren't for them, we'd be in a far greater recession than we are in today. So thanks to those people for coming in and keeping our stores open and spending their money to purchase things. This really does keep our economy afloat. Now, if we break down the population growth by province, Alberta has benefited the most from population growth. And it's no surprise. In Alberta, housing is cheaper, rent is cheaper, they have revenues from the oil industry, and they pay lower taxes. So of course it makes sense if you're coming to Canada to go to Alberta. But Ontario isn't far behind. This light blue line is the average in Canada, and Ontario is above average. And once again, the important point that I want to make about this graph is that this is the annual change in population growth. So in Ontario, our population is very big, and therefore the change in population growth isn't as big as Alberta. But because we already have a big population, this actually means that many people are still coming to Ontario. So the new immigrants are keeping our economy going strong. So Now, let's answer the question, where does the Bank of Canada go from here? Because that's a very important question. I'm sure that's on everybody's mind, and that's the million-dollar question. So what we have is interest rates are at a 22-year high. Many mortgages are coming up for renewal. Real GDP per capita is falling. Consumer spending is falling, and it's forecast to fall, according to RBC. And the unemployment rate is rising. Now, the last and final piece is the Canadian inflation rate is close to its target rate. So I think right now, pretty much every economist in the country agrees that where we're going is we're heading towards rate cuts. Now, the opinion is different from one economist to another of when these rate cuts are going to happen, but the consensus is that the rates are going to get cut, and they're going to get cut next year. So just to highlight this point, I went on to some of the top banks in Canada. I went on their websites, and they each post economic forecasts to show you and to show their clients where they think the rates are going to go. So here's Scotiabank's forecast for 2023, and the letter F next to it stands for forecast. So this must be one that's a little bit older, where they were just still forecasting for 2023. They're projecting interest rates to be at 5%. And in 2024, they're projecting at the end of 2024, interest rates are going to be 4%. And in 2025, they're projecting they're going to be 3.25%. The website where I pulled this data from is scotiabank.com. You can go to this website if you want to compare the data. And I've graphed it for you so that you can see the trajectory. You can better visualize their trajectory that they're projecting the interest rates will go in. Now, like I said, the banks, their economists, they're different, and they forecast different things. So just for your entertainment purposes, we went to some other banking websites and pulled their data as well. Here's BMO's forecast. They're forecasting that the rates will stay a little bit higher for a little bit longer, that they're going to start being cut in Q3 2024. And by Q4 2025, the average rate will be 3.17%. That's the overnight rate for the Bank of Canada. Here's the link from the website where they posted this data. And last but not least, here's TD Bank's forecast. Now, this one is my favorite because it's the most aggressive one, projecting that by the middle of 2024, Q2, the rate will be cut by 0.5%. And by the end of 2024, the overnight rate will be 3.5%. So that's the rate that the Bank of Canada sets. And that by 2025, by the end, it will be 2.25%. So their forecast is by far the most aggressive. You can decide on which forecasts you want to believe, but I think that the point that I'm trying to make is that they all agree that rates are going to start to be cut in the middle of next year, and they're going to get cut to around 3 to 2% by the end of 2025. Which brings us to our next question. And the next part of our presentation, or my presentation, is what should you do in terms of your mortgage? Since rates, are getting cut, we've seen the forecast from the banks, we've seen the economic indicators saying that the economy is slowing down, and the Bank of Canada knows this. They know they need to start cutting rates soon. What should you do? Should you go with a fixed mortgage, a variable mortgage? Should you go with a 1 year, a 3 year, a 5 year? What should you do? And this really depends on your situation, your risk tolerance. If you have a fixed budget and you want to make sure you don't go out of this budget, it might make sense to go with a 1 year or a 3 year fixed. Of course, right now, those rates are a little bit higher than the 5 year. The 5 year is the lowest rate, but you have to ask yourself, why is the bank giving you a 5 year fixed at the lowest rate? And it's because, well, they know that interest rates are coming down, so it makes sense for them to offer the 5 year as the most attractive right now, whereas the 1 year is priced significantly higher. But I think that if I was to get a mortgage for myself right now, I would probably go with a variable rate or maybe a 3 year fixed. because by the end of 2025, rates will be significantly lower. We don't forecast that they're going to go lower than 2.5%, the Bank of Canada's rate. So it would make sense that you should aim to renew your mortgage at the end of 2024 or 2025, or go with a variable. But of course, everybody has a unique situation, so I'd recommend consulting with your banker or broker to determine what's the best rate for you. Of course, there are pros and cons to fixed versus variable rates. I'm sure most of you probably already know what these are. Fixed rates are predictable and less risky. The negatives are that if the rate falls, you don't benefit, and penalties are higher if you want to break your mortgage. The variable rates, the payments will be lower if the rate falls, and you always have an option to convert your variable to a fixed rate. So for example, if you take a variable and in 2 years the rate is low and you think this is a good time to lock in your rate, you can always call your bank and convert that variable rate into a fixed rate, but you can't do it the other way around. If you have a fixed rate, you can't call your bank and ask to convert it to a variable rate. So that's the benefit you get with a variable rate mortgage. The con is, your payments might go up. With the data we have right now, we're not forecasting that, but things always can change. And yeah, there's a bit more management involved, right? You have to track the rates. If you think that they're going to go up, you need to lock in. So that's part of the downside with a variable mortgage rate as well. So the last thing that I want to talk to you about is which lender to choose. And well, I'm sure you're all aware of the 5 big banks that we have in Canada. I'm sure you bank with many of them, but there are many other lenders that offer mortgages other than these 5 big banks. And these lenders, they don't have branches on every corner. They don't have ads on TV. They don't own sports teams. They don't have seats at Blue Jays games. They don't own arenas. So what they do compete on is rates, because they can't compete on marketing. They can't compete on market share. They don't have your checking and savings accounts. So their only way to compete with the big banks is on products and rates. So there are a lot of these lenders out there. I just selected the ones that you might be familiar with. There are over 30 other lenders that the brokerage that I'm with works with. So we have access to these lenders, we have access to their rates, and it would make absolutely no sense to go to each and every one of these lenders, get your credit pulled each and every time, submit your documents each and every time. That's where you can leverage a mortgage broker. If you qualify with an A lender, the lender pays the mortgage broker, so you don't have to. And the mortgage broker shops around and finds the best terms, conditions, and rates that suit your situation. They provide you with a few options. They go over the options with you, and they help you choose the rate. So the bank pays the mortgage broker a referral fee for bringing in the deal, and it saves you a lot of legroom. Now, if you're self-employed and you're a business owner, it's a bit different because, as you probably know, you write off a lot of your taxes and you don't show that much income. So it's a bit more complicated qualifying when you're self-employed. But alternative lenders do exist. They do charge higher fees, but the cost savings of not paying your taxes have to have some drawbacks as well. And part of those is qualifying for a mortgage is a bit harder, but of course, a good mortgage broker can help you with that as well. So that brings me to the end of my presentation. Thank you so much for your time. If you have any further questions about mortgages or the economy, you can always email me or call me. Thank you.